Hello, everyone, and welcome back to Intermediate Macroeconomics. I'm your professor, Dr. Bradbury. We're moving into the second section of our second section of the classical model. So the classical model part two, if you will. Last time around, what we did was deal with money prices. We developed the equation of exchange. We also looked at classical theory of money demand, and from it, we articulated a aggregate demand curve. What we then did was look at the effect of increasing the money supply on the aggregate supply, aggregate demand equilibrium, and what we saw that the consequence in the long run, at least, was purely inflation. This time around, we're going to continue reinforcing these ideas of the classical idea of the classical dichotomy, if you will, the separation of real and nominal variables. And we'll do so in discussing interest rates, interest rate determination, as well as a phenomenon called crowding out, which relates to fiscal policy. Our determination of the interest rate is going to be brought to us by the FISCHER equation. The FISCHER equation, R is equal to I minus pi. What is R? R is the real interest rate, the real rate of growth of the purchasing power of some nominal sum of money. I is the nominal interest rate that might be quoted by a bank or something, and pi stands for inflation. Yeah? And we'll be using pi to stand for inflation for the rest of the class. So here we have it. The real interest rate is equal to the nominal growth rate of money minus the nominal erosion of money's value. The real interest rate is equal to the nominal interest rate minus inflation. Supposing that the nominal interest rate were 10%, but inflation were running at 7%. This would make the real interest rate 3%. Right? You'd only be 3% more wealthy. Your money might be growing at 10%, but its value is eroding at 7%, leaving you with 3% real growth of your money. Now, since we don't have a crystal ball, inflation in the future is unknown. So we're going to have to form an expectation of inflation. And you could look at the appendix of this little lecture if you want to see how we actually estimate inflation expectations using financial market data. But we'll have to form some kind of expectation of inflation. This causes the FISCHER equation to be written as the real interest rate is equal to the nominal interest rate minus the expected amount of inflation. Now, we can solve this for the nominal rate of interest, and we can see that the nominal rate of interest is equal to the real rate of interest plus inflation. So just like with all the other variables in classical economics, we're going to start seeing that the real interest rate is fixed because it is that real interest rate that causes people to save a specific amount of money or invest a certain amount of money, and in equilibrium that interest rate has to sort of be constant. We'll look at why that is. In the classical dichotomy, remember nominal variables such as inflation affect other nominal variables such as the nominal interest rate, but not real variables. So if we're looking at that third equation, where we've solved for the nominal interest rate I, we have I is equal to R plus pi. Take R as being fixed, right? In that case, if you see inflation, pi goes up, right? The overall effect is going to be that the nominal interest rate rises to compensate for it, thereby keeping the real rate of interest constant. So we're starting to see the classical dichotomy here in the FISCHER equation as well. It's one of those equations that you should probably memorize, become extremely familiar with, because it gives you a wonderful shorthand for one of our key macroeconomic variables, which is, of course, the nominal interest rate. The relationship between inflation and the interest rate, here's the data, 1995 through 2009. The x-axis, of course, has the inflation rate, and the y-axis has short-term nominal interest rates. You can look at this scatter plot. It's for various countries, and what we see is clearly there is a fairly strong positive relationship between the inflation rate and short-term nominal interest rates in at least these 89 countries that we've sampled. So our FISCHER equation theory seems to be bearing out fairly well. Here we have expected inflation and interest rates on 3-month Treasury bills from 1953 to 2008. One of the things that you should be noticing just on a cursory glance at this data is, of course, that they seem to be related. They seem to be very, strong co-movements between expected inflation and the interest rates. One of the other sort of trends that you probably notice from this is that most of the time the nominal interest rate is above the expected rate of inflation, which means that real interest rates are positive. However, there are certain instances where that is not true, notably in the late 70s, early 80s, when strong positive inflation started to surpass interest rate movements, leading to a negative real interest rate, and also a return to a negative real interest rate just before our crises in 2004, 2005. But generally, they tend to move together with the nominal rate outpassing expected inflation, generating for us real rates of interest that are positive. To build our model of the interest rate, we want to go beyond just discussions about dynamics of the Fisher equation, although those are fundamental to your knowledge moving forward. And here we're going to develop from the classical perspective a simple model of interest rate determination. We're going to do that the way that we determine the variables, or the way that we determine variables in all of our economics sort of courses, through building a market. What market are we going to build? We're going to build the loanable funds market. And in this market, we're going to have a supply and demand curve. The supply of funds that can be loaned will come from individuals saving. The demand for funds that are out loaned, looking for people to borrow them, will come from business investment. So we've got another separation between household decisions and firm decisions. Households are the ones providing savings to financial markets and financial institutions. Those financial institutions are then finding ways to lend them out to businesses so they can conduct business investment. So let's get to know these two agents in the market, saving and investment. Try to determine what variables influence their decisions and try to find an equilibrium interest rate given those factors. So let's look at private savings. Private savings is going to be the money you have left over after your disposable income gets used for consumption. So here we take it that your disposable income exists. Whatever you don't consume is left over to save. Now, we're dealing in the classical model here, so we have to keep in mind that income is assumed to be fixed by supply-side factors, right? Thus, if you're going to see an increase in savings, it has to come with a trade-off. It has to require a reduction in consumption, if you will. Let's talk about that. The household is really looking at a decision. Consumption brings utility to me in today's terms, with today's consumption goods. Savings doesn't just disappear into a hole. It's set aside so that in the future you can cash that savings out and use it to buy consumption goods. So what savings is consumption in the future. It's postponed consumption. So we're looking at a trade-off between utility from consumption goods today and utility from consumption goods at some future time. Yeah? The interest rate represents the reward for savings. The interest rate then represents the opportunity cost of consumption today. Look, if I've got disposable income, I use it to consume with today, I get the utility of today's consumption, but I lose the utility of tomorrow's consumption that would have had I saved, right? So that interest rate will govern the value of, right, consumption today versus consumption tomorrow, or savings, yeah? Our savings function will depend primarily then on the real rate of interest, which, as we know from the Fisher equation, comes from the nominal rate of interest and inflation expectations. As the interest rate increases, the opportunity cost of consumption today starts to rise, and individuals are more likely to substitute towards savings and away from consumption since there's a higher reward of doing so. The opposite is true when interest rates are falling. If interest rates are low, the utility from future consumption is not going to outweigh the utility from present consumption, and people are going to save very little and consume quite a lot. This is the classical theory of savings. When we move into the Keynesian model, we'll develop a more articulated Keynesian version of the savings function, and they will be different. So make sure you understand the underpinnings of this one, just in case you're asked to compare and contrast in the future. Now let's move on to investment. Investment in the loanable funds market. This is loanable funds demand. This is businesses looking to borrow funds to invest, if you will. Our investment function has a couple variables that we need to take note of. One of them is the nominal interest rate. Another is inflation expectations. Yeah. And yet a third one is expectations in general. And we'll talk about what those are at this point, right? Our nominal interest rate and inflation expectations provide us with an estimation of the real rate of interest. What is it going to cost me to borrow, if you will? And then expectations, we'll talk about those in a second. They have a relationship between how profitable you think an investment endeavor is going to be, right? So put yourself in the shoes of being a analyst or something in a large firm, and your CEO comes to you and says, we're thinking about expanding the business. And so what we want is for you to come up with some potential business investment ideas. And so you do so, right? You pull up a bunch of data, you look at a bunch of different markets, and then you propose these business ventures. You say, well, we're going to put shopping malls in China, or we're going to invest in real estate in the Southwest, or we're going to build a rival to kombucha. And then your boss said, well, these are all great ideas. How much money will they bring in? And so you started to look at data about consumers and consumer preferences and income levels and comparable services and what they sell for, and the state of the economy and whether or not we were expecting a boom or a bust and what were the incomes of these consumers expected to be, and so on and so on and so forth. And then you'd put forward a spectrum of business opportunities from the most highly profitable to the most lowly profitable, right? And then your boss would say, well, which one of these can we actually afford to take on? And you would say, well, our kombucha idea is going to bring in 10%, interest rates are 5%, that brings us a 5% profit. Yeah. And our shopping mall in China is expecting to bring in 7% and interest rates are 5%. That gives us a 2% profit. And so we're going to take that. And our idea about real estate in the Southwest is going to bring in 4% and the interest rates are 5%. And so we take a negative 1% loss. We're not going to undertake that investment. And so we take the profitable investments where the marginal benefit of investing exceeds the marginal cost of investing, which is borrowing, the cost of borrowing. Yeah. So clearly what we're going to see is that investment is negatively related to the interest rate. Yeah. As the interest rate declines from 5% to 3%, all of a sudden that 4% real estate deal in the desert Southwest brings us profit. And so our level of investment increases. So we'll see a negative relationship between the interest rate and the level of investment. If interest rates rise, the cost of borrowing, the cost of investing rises relative to our perceived benefits of profitability, and we reduce the level of investment. If interest rates are declining, of course, the marginal cost of investing is going down relative to the marginal benefit, which is, of course, our estimated, returns, and we're likely to invest more. Yeah. So a negative relationship between investment and the interest rate. You might want to think about it in these terms. You're thinking about going to college and you have to borrow money to do so. Are you likely to purchase more college if interest rates are very low on student loans? Or are you likely to stop at a technical degree or a 2-year degree if interest rates are very high on your loans? Well, it's the same relationship, right? Interest rates are low, you're going to invest more in your education. Interest rates are high, you're going to invest less in your education. And that, of course, is why we have subsidized student loans in order to try to keep financing for education cheap to the student so that they end up buying more education than they otherwise would. You could run through the same parallels in terms of mortgages for house purchases or interest rates on car loans or just whatever, you would like to, except here we're talking about business investment, right? Let's talk about the last component of the investment function here. We talked about interest rates. Now let's talk about expectations in general, right? When you were forecasting all of these businesses and their revenues, these were businesses that were not yet built. These were businesses that were operating at some point in the future. And so you had to estimate future GDP growth, future investment consumer preferences, right? Future consumer incomes, and so on and so forth. Those were all expectations, if you will. Right? And those expectations can change. You had estimated that your kombucha business would bring in 10%, and then you open the paper and it says, kombucha is proven to cause cancer. you're going to have to revise your expectations about how profitable your kombucha business is. Particularly, you're going to revise them downward, right, from 10% much lower, to 2% or something. And at which point, right, your marginal benefit of investing, the value to you, the perceived expected value of this investment will start to decline, And if interest rates are 5% and now this is expected to bring in 1%, well, you're not going to do it. So investment expectations will model by shifting the investment demand curve. We'll show you that in the next slide. But when we talk about expectations, generally and casually, we talk about them in a way that John Maynard Keynes brought them up, which is that they're related to animal spirits. And we'll talk more about this later when we get into the strict Keynesian section. But there are really two types of animal totems or animal spirits for Wall Street. One of them is bullishness. The other one is bearishness. Now, if you've ever been down to the Wall Street area in New York, you know that there is a gigantic brass statue of a bull down there. And we kind of have to ask the question, did there used to be a ranch down here on Wall Street, or why is this giant bull here? Well, the bull is meant to represent a big, powerful, dominating, charging economy. So high profitability, high economic growth, optimism, profitability, low unemployment. It's a healthy, charging, growing economy. And so they have a totem for prosperity down there, which is the big brass bull or the big gold bull. Bearishness, on the other hand, is supposed to represent a large, sluggish, hibernating animal like a U.S. economy that moved into some sort of lack of profitability, high unemployment, and recession. So when people say I'm bullish on the Yankees winning the World Series, it means they're optimistic that the Yankees are going to win. If they say I'm bearish on the Colorado Avalanche winning the Stanley Cup, it means they're really pessimistic. They're probably not going to bet on the Avs for the Stanley Cup. So that's bullishness and bearishness, and we'll talk about that with respect to business investment. Are you optimistic that your kombucha is going to do very well in the market, or are you bearish on that because of your expectations? This will shift around, right, your investment demand curve. Let's put these two curves together, right? On the x-axis, right, we have the amount of savings and investment that's actually transacted. On the y-axis, we have the real interest rate. Now, we have an upward sloping blue line. This is the savings curve. As the real interest rate increases, the reward for saving increases relative to consumption today, and people reduce consumption and increase the quantity of savings available in the loanable funds market. If interest rates decline, well, the opportunity cost of consumption today goes down, and people are more likely to consume today and less likely to save, so the quantity of savings declines. Our next curve is the downward sloping blue line. This is the investment demand curve, and you can see that it's negatively related to the real interest rate. At high real interest rates, such as R2, right, we're operating at point A on the investment demand curve. Now, that investment demand curve you can think of as being that ranking of all of the profitabilities of the various investments that you were looking at, right? So A might be a 10% kombucha, and E might be a 7% real estate investment in south, part of the United States, and D might be a toenail clipper business that you were thinking of, right, that would bring in 3%. So it's all of your businesses ranked, right, ordinally ranked from highest to the lowest expected revenues, if you will. Now, the location of that curve, right, depends upon your expectations. So, let's suppose that point A represented a 10% revenue for your kombucha business, and the next thing you know, all of a sudden kombucha causes, cancer or something. You're not going to keep that expectation of kombucha at point A. It's going to drop, right? It's going to drop down towards point C. So if we were looking at your investment portfolio ranked from highest to lowest expected revenues, and then all of a sudden it said, you open the paper and it says there's a recession coming, consumers are seeing lost income, so on and so forth, right? Then you're probably going to shift that entire line down to represent the expected revenue streams from all of your businesses being revised in a more pessimistic direction. A shift downward or leftward in that investment schedule would be consistent with bearishness on the part of investors. And a shift to the right or up of that investment curve would be bullishness on the part of investment. You'd be expecting higher profitability across the board. So those are our two curves, right? Our savings schedule and our investment schedule. Let's talk a little bit about how inflation, right, might impact the equilibrium level of the interest rate. But, before we do, let's look at some disequilibriums so that we know how we return to equilibrium. Let's take, for instance, a rate of interest that is above the equilibrium rate, such as R2, right? At R2, the rate of interest is quite high, meaning the cost of financing investment is quite high, and you're only going to be able to take on your most highly grossing endeavors. So investment demand is very low, operating at point A. Now, the reward for savings is extremely high, so consuming today doesn't make sense. You'll be able to consume so much more in the future. And so we've repressed consumption and pushed savings up in this market to take advantage of those high interest rates. Savings is operating at point B. Now, what you can see here is that point B is outstripping point A, right? Here we're dealing with a situation where savings is greater than investment. We have a surplus in the loanable funds market. People are looking to find entities to borrow their money, and those entities are not willing to borrow because interest rates are too high. So interest rates begin to fall. As interest rates fall, we're able to take on more investment opportunities at lower gross revenue. And so point A starts slipping down the investment demand curve, riding along the curve towards point E. Similarly, as interest rates begin to fall, the savings and consumption trade-off starts to tilt more towards consumption as a reward for savings declines, and we start sliding along the savings curve from point B down towards point E. Interest rates must continue to fall so long as there is excess savings in the market, and as interest rates fall, investment grows and saving falls until once again the market is in equilibrium, where all of the savings that is out on the market is borrowed, supply is equal to demand, savings is equal to investment, and we're operating in an equilibrium point E at equilibrium interest rate R star. Now let's turn to inflation. We know that we have, at least in the long run from the Fisher equation, that the real interest rate is equal to the nominal interest rate minus inflation. A rising price level, right, would then push up pi. Everything else sort of held equal right now, this would drive down R, right? So rising inflation will push down the real interest rate. In the diagram, we'd be moving from R star to R1. The real interest rate would be declining, and we're motivating that, in this example, by an increase in inflation, an increase in pi. So now we have a problem. We've moved from R star, and inflation has driven us to lower interest rates at R1. At R1, savings is at point C, and investment is at point D. And what we see is that savings is inadequate to investment. What we see here is there's excess demand for loanable funds. So firms are looking to borrow money, but that money's not available to borrow because interest rates are too low. They'll start bidding up the cost of savings, right? Driving up the interest rate. And the interest rate will continue to drive up. As the interest rate rises, these profitable business endeavors become fewer and fewer, and D starts moving along the line towards point E. As interest rates rise, we start to encourage less consumption and more savings, and C starts slipping along the savings curve up towards point E. Yeah. Essentially what we're doing here is we're driving up nominal interest rates until once again the real interest rate is consistent with our equilibrium at R star. So first we pushed up pi, and that was inflation. Secondly, we pushed up I, and that drives our R back to its equilibrium value at R star. Now, keep in mind that if inflation was growing at 3%, well, the nominal interest rate would also have to grow at 3% in order to return to our equilibrium R star. So we have the classical dichotomy again, right? Movements in a nominal variable such as inflation generate equivalent movements in another nominal variable such as the nominal interest rate, causing us to see no change in the real economic variable, the real interest rate, and consequently no change in the amount of savings and investment that's getting plowed into the economy. So movements in inflation will not generate financial cycles that will destabilize the economy. Any movement in inflation will be absorbed in the loanable funds market by changing nominal interest rates such that the economy is stable at R star and our specific long-run level of investment. So this movement in the nominal interest rate has absorbed the volatility of inflation such that it doesn't impact the economy writ large. Now that we have our now that we have our loanable funds market equilibrium in play, and we've learned how to incorporate, price changes into modeling a long-run vision of the loanable funds market that is consistent with the classical economy, let's look at how shocks might be incorporated into our loanable funds market and ask the question, will these shocks other than the movements in the price level, will they generate some kind of disturbance in the macroeconomy, right? And the answer for the classicals essentially will be no, right? Let's look at this. We have, again, the interest rate on the y-axis, and we have loanable funds on the x-axis, the amount of savings and the amount of investment. We're going to start off with the black line that is consistent with our investment demand schedule, I0. So you can see it there. It's I0, the downward sloping investment demand schedule. We'll start there and with the upward sloping savings line, which is just S because we're not going to be changing it. So initially we have an equilibrium at R0 and S0 equals I0. So R0, the interest rate R0, is creating an equilibrium where savings is equal to investment. At levels, S0 equals I0. And everything's humming along just fine. Now comes the shock. There is a downward revision of expected profitability of investment. We've seen pessimism or a bearish outlook in the market. How will this influence our loanable funds market? Well, this is a change in expectations, and particularly it's business expectations, and it's a negative shock to business expectations. So the investment demand schedule will shift down or leftward, they're equivalent, right? And so here we see the investment demand schedule shifting, right, from I0 to I1. Yeah, and that's how we model this bearishness. If we were doing something with bullishness, this shift would have been in the opposite direction, right? The investment demand schedule would have shifted to the right or shifted up. But here we're dealing with bearishness. So we've got a leftward or downward shifting investment demand schedule. At the old interest rate R0, we no longer have equilibrium. In fact, we have a disequilibrium, yeah? Now, look at the brackets there, that distance where we shifted from our old equilibrium at R0 and I0 to our new disequilibrium. We've got that shock there. The distance by which investment fell is indicated by delta I, right? That's the change in investment. So again, the amount by which investment declined due to this bearishness is indicated by the bracket delta I. So here we have an issue, we have a disequilibrium. What is the disequilibrium? It's excess savings in the loanable funds market. We've got a surplus here. And because we have this surplus, interest rates will start to fall. As interest rates start to fall, we'll be moving down the savings schedule in a leftward fashion and down the investment demand schedule, I1, in a rightward fashion. We'll just be moving along the line, right? Lower interest rates will cause us to recoup some investments, and lower interest rates will cause us to lose some savings in the loanable funds market. So let's take a look at that just really briefly. We're moving from the old equilibrium, and in terms of savings, we're moving down the savings schedules to the new equilibrium at R1, yeah? So here we have this bracket A. You look at the bracket A. That is the amount of savings that we have lost from this market. So as interest rates declined from R0 to R1, we slid down the savings schedule, losing or reducing savings by the amount A. Similarly, as interest rates declined from R0 to R1, we moved down the investment 1 schedule towards our new equilibrium at R1. That distance, B, is the amount of investment which was recouped, right, because of falling interest rates, right? Interest rates have a negative impact investment. As we move from R0 to R1, investment grows, and it grows by the amount of that bracket B, right? So initially, we had a negative shock to investment. Part of that decline of investment has been made up again because of falling interest rates. And so take that bracket delta I and reduce that bracket by B, right? That's part of the recouping of lost investment that's come from falling interest rates. Well, what about that bracket A? That makes up the rest of the lost investment. As we know from our theory of the classical savings schedule, that savings and consumption are a trade-off. So if savings is declining by the amount A, it must mean that consumption is rising by the amount A. Consequently, if we look at our equations on the left-hand side, the overall composition of demand in the economy remains unchanged. Yeah? We saw a negative shock, a decline in investment, but that decline was partially made up by recouping business investment, delta I, through falling interest rates, and partially made up through growing consumption expenditure, delta C. So overall, aggregate demand, as we look at it through the expenditure approach, would be unchanged, right? I would fall, and then I would rise again, and the rest of aggregate demand would be increased by changing C, or falling savings. So aggregate demand, consumption plus business investment would be totally unchanged. This is a policy lesson from the classicals. What they're saying here is that you could have volatility in financial markets. You could have bullishness and bearishness. You could have, wild swings in business expectations. And the interest rate would absorb those wild swings in business expectations such that you didn't see a meaningful change in aggregate demand, right? And thus, the aggregate demand curve would be stable, yeah, and you wouldn't see rising unemployment or falling unemployment as a consequence of bullishness and bearishness. You just see changing interest rates as a result of bullishness and bearishness, but not changing conditions in terms of aggregate demand. So here, aggregate demand is resilient to volatile investment expectations because the interest rate absorbs those volatile disturbances. Do make sure that you take a moment to understand the proof I've just given you, right, so that you can see how delta I is made up by bracket B and bracket A, and noting that those brackets are associated with rising investment and or rising consumption. Let's take a brief moment to delve into business expectations, if you will, right? We generally spoke about business expectations from a pretty kind of straightforward approach. We said, look, they're either going to be optimistic or pessimistic. They're either going to be bullish or bearish, right? Now, there are lots of competing theories about what actually drives business expectations on Wall Street, what actually drives bullishness and bearishness, right? And a lot of what it's about is really there's a lot of profit in predicting future movements in, say, stock prices correctly, yeah? If you know it's going to go up in the future, you buy now, you make profit. If you think it's going to go down in the future, you sell now, you make profit, right? So there are many individuals who are highly engaged in predicting future market outcomes or forming expectations, if you will. And the reason they're engaged in it, of course, is there's a tremendous amount of money involved in it, right? So, economists have come up with many theories about what they think agents are doing on the ground in mass to form their expectations. And there are competing theories. The ones that you'll find in your textbooks, right, are called the efficient market hypothesis. The general idea here, if you go to a finance textbook or a money and banking textbook or even this textbook, right, you'll find that, formally speaking, the orthodoxy posits that business expectations are formed by something called the efficient market hypothesis. And maybe you've heard this before. The general idea behind the efficient market hypothesis rests on the assumption, which is fundamental to all of our economics, be it micro or macro, and that assumption is that all of the agents are rational, right? There's a tremendous amount of money at stake. Everyone has a lot of skin in the game. How are you going to make decisions? You're going to make decisions using the most efficient thinking process that's available to you, i.e., reason and science, right? That's what it means to be rational. Rational doesn't mean, well, I thought about it a lot. Rational means that you use the scientific method and the best thinking process available to you to come to your conclusion. Not just that you spend a lot of time thinking about it, right? That's what it means to be rational, or make decisions in a rational fashion, right? Let's also assume that trade is costless and frictionless, so that any of these real-world frictions we don't have to sort of think about or model. We can add them in later as we like to complicate things, but let's keep it as simple as possible. Furthermore, let's go ahead and assume that information is perfect. So whatever relevant information there is about Pfizer or Coca-Cola or Google or what have you, it's immediately released to the market. All of the players have it at exactly the same time, and then they, of course, can make decisions on buying or selling based off of that available information, right? So those are some assumptions there. And of course, the SEC tries to create perfect information and so on and so forth. And of course, trade is not costless or frictionless, but as technology starts to get better, it becomes increasingly frictionless, as you'll note from high frequency trading, and at very low cost, as you'll note from the ease of entry into financial market exchanges, if you will, right? So let's talk a little bit about this, right? Once we have these assumptions in play, well, let's ask the question, how will rational agents form expectations, right? Agents are assumed to form expectations according to the optimal forecast. They're going to look at all possible methods of forecasting and choose the best one. So y hat will be our statistical forecast of a variable. It could be a stock price, could be anything, could be the weather a week from now, right? Could be any of those things. So y hat is, of course, our forecast of that future variable. Y hat is equal to alpha, a fixed parameter, plus a vector of betas and a vector of independent variables, right? So beta and x could be any list of factors that might influence a stock price. And beta would be the weight of that factor, and the sign of that factor could be positive or negative in either raising or lowering your estimation of the stock price, y hat, right? Very good, right? And then our sigma there is going to be, it will be our errors, right? So sigma will be our errors, if you will. Now, the optimal forecast is this, standard equation where it is true that the sum of our errors is equal to 0. Yeah. So let's talk a little bit about that. Let's just do a simple example. Let's suppose that what we're doing, our y hat, is how much time we need to get to the university, if you will, right? We're going to think about all of the relevant factors and put them in that X category. We're going to say, how far does it take me to walk to the train station? How many transfers do I have to do? What's the average time of each transfer? How many stops are there? What's the average time of a door opening and closing, right? How long does it take the bus to get here on average? And how long does it take me to walk onto campus? Or what are the traffic lights? Or how long does it, on a typical day, cost me in terms of time finding parking? You'll look at all of the relevant variables that might influence the time it takes you to get to school, right? And then you'll statistically estimate this equation, solving for the betas, right? The weight of each of these factors. And then you'll come up with some conclusion. You'll say it takes me an hour to get to school. So tomorrow you wake up, you get in the train or in the car or whatever, you go to school and you're 10 minutes late. You were wrong. Your estimation was wrong. But does that mean that your forecast was wrong? The answer is no, not necessarily, right? Let's suppose that you were 10 minutes late, right, on day one. Yeah, and you say, okay, well, my estimate was wrong, but my forecast might be optimal. There could have been some random disturbance in the day that caused you to be 10 minutes late. Yeah, but it was a random disturbance, and it's not something that should be systematic in your calculation because it's unlikely to happen again in the same way that it happened today because it was random, right? So you wake up the next day, you go to school. The first day you were 10 minutes late. Now you're 7 minutes early. You were wrong again, but in the opposite direction. Is your forecast bad? Not necessarily. You wake up day 3, you go to school, and this time you're 3 minutes early. You wake up day 4, you're 5 minutes late. You wake up day 5, you're 5 minutes late. You wake up day 6, you're 10 minutes early. So hopefully you see what's happening here, right? There are errors that are causing you not to be perfect 100% of the time in your estimation of how long it took you to get to school. But those errors are not systematic. They are random. And if the sum of those errors is equal to 0 on average, then we know by definition that those disturbances are random and cannot be predicted. And consequently, your estimation of having an hour to get to school is the optimal forecast. And on average, it will be right. So if this was buying and selling a stock and you had set the stock value in this manner, yes, the stock might go up tomorrow or go down tomorrow, but as those oscillations occur, they will eventually cancel out. So your gains and your losses will disappear over time on average, and you'll end up being correct most of the time with your prediction of the stock price, assuming that you're using an optimal forecast, right? So that's the general idea behind this, is that every agent in the market will be using this form of estimation to decide whether or not the stock price is low, in which case you buy, and in which case the stock's value now incorporates all of the efficient expectations of every player in the market. Or suppose you had the estimation that the stock price was too high, and immediately you and every other rational agent would sell it, and the stock price would gravitate towards the optimal forecast of it, given all available information. Yeah. Now, stock prices could change, not because of anything systematic, such as trading, but because of unpredictable disturbances, right? Stuff you just didn't know was going to happen. But very quickly, those movements in stock prices would reflect that new information, and the value of the stock would have absorbed all of the predictive information such that it was correct and true to an accurate valuation of the stock, right? Now, suppose that you were 10 minutes early the first day, 10 minutes early the second day, 3 minutes early the third day, 4 minutes early the fourth day, 1 minute late the next day, 2 minutes late the next day, 10 minutes late the following, and so on and so on and so forth, so that the sum of your errors was positive. Now, this would mean that there are random disturbances that are affecting your forecast and likely some systematic disturbance affecting your forecast that's causing it on average to be biased towards being early, in which case you need to realize that you probably have not accounted for all the relevant information X and included it in your model. So you do so until the sum of your errors is equal to 0. Right? This is the efficient market hypothesis, and we'll discuss some competing hypotheses later on, namely hypotheses that are derived from the assumption that human beings and agents in markets are not rational and thus will not be using optimal forecasts in their trading decisions, but might be using other irrational or systematically irrational mechanisms in making their trading decisions. The policy conclusions that we see from the efficient market hypothesis are that stock prices currently reflect accurate valuations, movements in stock prices are random and unpredictable, market efficiency drives movements in stock prices so that any volatility is movement towards correct values. Volatility in the market is efficient thus, and the market is just incorporating new information as efficiently as it knows how. Thus, volatility in the stock market is not a sign of a problem, but a sign of an efficiency process, and regulation is unnecessary, if not damaging, if it might prevent that sort of efficiency process from taking place. Another sort of lesson from this is if you're an active trader, you're not going to be able to beat the market systematically. You might do so for a short period of time, but that's because of random disturbances, not your own wisdom or hubris, and thus it makes more sense to use a buy and hold strategy for a diversified portfolio. Now, I'm not saying these are gospel. I'm saying these are the policy conclusions of the efficient market hypothesis, and we'll talk about competing hypotheses at some other time. Let's move on to talk about public savings and government budget deficits and how they will be modeled in our classical loanable funds market. It'll allow us to get to the idea of crowding out. Let's turn to government at this point. Let's look at public savings and the government budget deficit, its impact not only on the loanable funds market, but also sort of in the same fashion as when we looked at shocks to investment. We'll look at the impact carrying through to aggregate demand. So public savings, of course, is the amount of money you have in excess of what you spend. And for the governments, that's their tax revenue minus government expenditure. Therefore, the measure of government debt or the government budget deficit would be G minus T, the amount that governments spend minus their tax revenue. Now, if you're spending more than you're taking in revenue, you are doing one of three things, right? I mean, if you're trying to pay for government expenditure, one of the ways you can do that is to tax. That's unpopular, and that won't lead to a government budget deficit in the equations above, but it's generally unpopular, and politicians don't like to do it because they like to get reelected. A second way, of course, that you can pay for government spending is to borrow it. And so government budget deficits will typically, at least in this country, be matched by government borrowing in the form of treasury bonds and treasury bills. A third way to pay for government spending is, of course, just to print money in order to pay for government spending, which becomes extremely dangerous when you note the connection between the expansion of the money supply and inflation. Printing money can be done in several ways. One of them can just be printing money and then spending it. Another sort of more clandestine way is, of course, to just have the government sell bonds directly to the central bank rather than to investment markets, thereby monetizing the deficit, if you will. Now, if there is a strong connection between increasing the money supply and inflation, then you'll note that inflation erodes the value of money and wealth. So printing money to pay for a government budget deficit will generate inflation that will erode the value of wealth in every citizen's bank account. So it's sort of equivalent to a tax in that way, and that tax is referred to in economics as seigniorage, or the inflation tax, more plainly, right? I can either raise your taxes by 10% and therefore your wealth will go down by 10%, or I can generate a 10% increase in the money supply, which will generate in the long run a 10% increase in inflation, which will, of course, erode the value of your wealth by 10%. So they're sort of equivalent, and printing money is a kind of sneaky way that unscrupulous governments can impose an inflation tax. So number two is what we're going to look at here. We're going to look at borrowing in the form of issuance of bonds in the loanable funds market. This is a display of the effect of a rise in the government budget deficit within the framework and the perspective of the classical model. Let's get our bearings first, right? And one of the things with these graphs is they look pretty complicated until you kind of strip them down and take them step by step, thinking about every shock, every causation, movement from one equilibrium to the next, the mechanisms that drive you from point A to point B to point C. And so take these slowly and take them bit by bit, dissect them, analyze them, and you become very familiar with them very quickly. Do note that your book provides these graphs, and they also provide excellent explanations of what's going on in the graph step by step. So if you don't feel like you got everything you needed from these narrated lectures, by all means make sure that you're backing it up with a thorough and in-depth reading of your text. So let's get our bearings here. We have the interest rate on the y-axis. We have the amount of loanable funds and government borrowing on the x-axis. This is the amount of private savings, the amount of private investment, and the amount of government borrowing, as is represented by the size of the government budget deficit, G minus T. We're going to start out at the knots, and so we're dealing with R naught and I naught S naught. This is an equilibrium at point E. And so initially we're dealing, of course, with just the private investment demand function, as is represented by our investment curve, that downward sloping curve. And then we've got the supply of loanable funds. This is our savings on the upward sloping curve. And initially they're intersecting where savings is equal to private investment at point E, R naught and I naught, as well as S naught, right? Now, the next thing we're going to do is we're going to analyze the rise in government borrowing. This increase in government borrowing pushes the investment demand schedule out by the amount G minus T. So what you can be thinking here is that absolutely nothing is happening with private investment decisions, but private investors are not the only ones issuing bonds to borrow money. Now, governments have added to that demand for savings. So we've got private demand for savings, which is private investment, and now we've got public demand for savings added into that, which is this government budget deficit. And as we do so, the investment demand schedule, together with our new addition, this government borrowing, shifts the loanable funds demand curve out to the right. Yeah, it shifts it out to the right. And so what you see in that next curve is that secondary downward sloping curve represents not only private business investment I, but also represents government borrowing G minus T. Now, if we look at that shift, every point on that curve would have shifted by the same amount. It would have shifted by the size of the government budget deficit. And so if we look at the brackets between, say, point F and the point on the investment schedule that's associated with I1, if we look at that bracket, that is the size of the government budget deficit. And that bracket will be equal distance anywhere between those two lines. We've placed it where it is for convenience, right? All right, so we've got an equilibrium at point E. Next thing you know, there's a shock, and the investment demand curve shifts out by G minus T. It shifts out by the amount of the government budget deficit. Well, our initial equilibrium, R naught, is no longer an equilibrium interest rate because we have excess demand for savings in the loanable funds market. That excess demand for savings is going to start driving up interest rates, and interest rates will have to rise until demand for savings is equal to supply for savings, which will occur at point F. We now have a new equilibrium in the loanable funds market at point F, at interest rate R1, and at S1 equals I plus G minus T1. So that's our new equilibrium. Now notice what's happened. As the interest rate has increased, we've seen an increase in savings. The amount of increase in savings is indicated by our bracket A. As the interest rate increased, we would see a reduction in the amount of private investment. And the reduction in the amount of private investment, the size of it, right, would be the same as if governments were there or not, right? And so that amount of reduction in private investment would be bracket B. The rise in interest rate has two effects: increasing savings, bracket A. This comes, notably, in the classical model as a decline in consumption. Decreasing private business investment, bracket B, which is shown to you there. We go from I naught to I1, yeah? So if we're looking at these magnitudes, we have seen an increase in government borrowing. The size is G minus T. Perhaps the government was borrowing to try to stimulate the economy, right? Government purchases of automobiles or services or Lockheed Martin airplane F-16s or what have you, right? This idea that government spending might stimulate aggregate demand for goods and services and lower unemployment. Well, the classicals say, no, that won't be the case. Whatever increase in demand comes from running a government budget deficit will be offset by discouraged private investment and discouraged private consumption. The discouraged private investment and discouraged private consumption happens because government borrowing drives up interest rates in the loanable funds market. Essentially, the government has pushed out private consumption and private investment. It's made them too expensive, as it were, right? This effect is called crowding out. So when we look at this, we see the increase in G is equal to the reduction in consumption and the reduction of private investment. That increase in G has crowded out private consumption and private investment. If we look at an expenditure expression for aggregate demand, which would be C plus I plus G, all of the entities that could demand goods and services, we see that G has increased by the same amount that C plus I has fallen. And thus, there is no change in overall aggregate demand. The idea here is that governments, in terms of raising spending, can have no impact on aggregate demand and no impact on output or employment. Thus, we arrive at the policy conclusion. If crowding out is total, the government can have no effect on overall aggregate demand. Hence, they shouldn't even try. Take a laissez-faire approach. Governments shouldn't get involved in trying to stabilize the economy because they have no impact on the economy. In fact, another sort of corollary argument is that they do have an impact on the economy, they just don't have an impact on aggregate demand, output, or employment. The effect that they do have is that the composition of aggregate demand becomes increasingly dominated by the government and less determined by consumption and investment. Why might that be a bad thing? Well, in the classical model, consumers are basing their decisions on the prospect of utility maximization. They buy goods only from the firms who provide the most efficient utility at a given price, right? They shop around, try to find efficient producers who can give them the good at a very high quality for a very low price, thereby rewarding efficient firms and punishing inefficient firms. Gradually, this consumer utility optimization should weed out inefficient, unproductive firms and sort of reward efficient, productive firms. In the same vein, business investment is supposed to be based off of a rational profit maximization scheme. So when they decide to invest in a new development of some kind or a new business venture like building a new Airbus or a new F-16 or something, they're doing so on the basis of thinking about a rational consumer and trying to build businesses that are the most efficient and that will generate the most profit. So the composition of GDP here, right, the market disciplinary dynamics, dynamically reward efficiency and profitability and dynamically punish inefficiency and lack of profitability, such that the overall structure of GDP becomes increasingly efficient, thereby generating economic growth. The argument is that as governments enter into demand, they may buy from firms that are not necessarily efficient, but that gave large campaign donations, that aren't necessarily efficient, but that are associated with the politician in some preferable way, like having a strong, lobbying effect or something, right? Such that the structure of demand, if it's increasingly governed by governments, there's no guarantee that it's as rational as that of private consumers and private investors. And so the economy is likely to become increasingly less efficient and grow slower. That's a secondary argument against government intervention in markets that was frequently brought about by classical economists, and you sometimes hear today in various guises. The first argument from the classicals against government intervention in markets is that they have no effect, at least no positive effect on output or employment. They're powerless. The second argument against them is that if they do enter the market, they are powerful at reorganizing the structure of aggregate demand to make it less efficient and slow economic growth. These are the classical arguments against budget deficits being used to sort of cure recessions or end expansions through generating surpluses. In brief summary, what we have done here is look at aggregate demand, build it, construct it, and prove that it is stable when dealing with shocks coming from volatile business expectations, price movements, or government intervention in the form of budget deficits. We've shown that business cycles are self-correcting, right? All we need is movements in prices, and any instability in aggregate demand will be absorbed through price movements. Any instability in terms of business expectations will be absorbed in nominal interest rate movements, and any volatility in prices will be absorbed in nominal wage movements. Governments can only do harm intervening in the economy, and crowding out is complete or total. Hence, laissez-faire. Governments should not take an active approach in the economy. We saw this reinforced with looking at money supply as well, right? Money supply would simply generate movements in aggregate demand, which would be absorbed by prices, generating inflation, right? So monetary policy authorities and fiscal policy authorities should really do nothing, if not very little, just only the absolute bare essentials in terms of interacting with the macroeconomy. For instance, governments may have to provide goods and services that private markets fail to provide. These things are chalked up to being things like, well, public goods, as a matter of fact, which we could have a long discussion about. One example of a public good would, of course, be national defense. It makes sense for governments to tax and spend to, protect the country, because that wouldn't work in a private market, And there are several other examples of public goods, if you will. Oftentimes, infrastructure becomes an important one, the building of roads and highways. You can imagine if Ford Motor Company needed to build the national highway system before their automobiles had any utility to consumers. Well, that would be an unprofitable project. But if the government can build that infrastructure, then all of a sudden Ford's automobiles become very valuable to the consumer because they have roads to drive on, right? So public goods are a role for the government to tax and spend. There is space for it, but the classicals believed it was a very limited or curtailed space. Only money influences aggregate demand, and money is neutral in terms of impacting real variables such as unemployment or output, although it is certainly powerful at impacting inflation in the classical world. Monetary policy should follow a non-discretionary rule targeting price stability, and this would be achieved in the most rudimentary way by growing the money supply at the rate of nominal GDP. There is an appendix slide to this lecture. I will flip on to it, but it is, of course, optional for those of you who are interested in doing a little bit more. It deals with expected inflation. Other than that, we'll be concluding our section on the classicals and moving into the Keynesians. So be ready for the next series of lectures, and make sure that you know this classical stuff really well, because we're going to be doing some comparing and contrasting with a very different model and a very different set of policy conclusions that comes from the Keynesian approach.